We are certainly seeing a lot of news in the market about housing and affordability, recession, and a cool down. So we wanted to take this opportunity to dive into the Canadian housing market and give you a rundown of the key elements and key topics that you should know as Canadians. In terms of inflation level, it is currently at an unprecedented level at 8% and is still expected to go up modestly in the near term. When we look at historically, it's always been around 1 to 3% and in range and averages around 2%. So at this level, it has caused a lot of rippling effect amongst Canadians where now gasoline prices are more expensive, food prices are expensive, etc. This has really triggered Bank of Canada to increase its overnight rates. On the onset of COVID, they have decreased rates to an all-time low, making it super cheap to borrow. There's a lot more spending, causing housing market as amongst others to go up. They have now starting to increase rates at a pretty fast pace, and now it's at about 2.5%. And the market is predicting 4 more rate hikes, 2 in September, 1 in October, and 1 in December, equating to about a 1 full percent increase in rate hikes. And this further hurts the affordability level for Canadians. When we do a deep dive of the housing affordability, it's certainly at a level that is one of the worst that we've seen over the last 20 to 30 years. This chart represents the percentage of household income that's being spent on monthly mortgage payments. In Canada, the line is the brown line, and that represents 54% of household incomes being spent on monthly mortgage payments. That's at an all-time high, and you can see that it's a clear uptick over the last few years. And the situation is much worse in Vancouver and Toronto, Vancouver being 81% and Toronto being 76%. There's other cities such as Montreal that has a better affordability level where only 38% of their income is being spent on monthly mortgage payments. RBC, which is one of the large Canadian lenders, did an analysis where an increase in 1% rate hike would push the Vancouver and Toronto unaffordability level by another 8 to 9% to a level that's completely unaffordable. And what does that mean from a monthly mortgage payment perspective? With a 1% rate hike, it translates to an increase in $600 in Vancouver a month, $550 in Toronto, and $480 in Victoria. This is analysis that's based on the median home in these various cities and what a 1% rate hike would translate to from an additional payment. These 3 cities are higher than the Canadian average of $360 per month. National Bank, which is another large Canadian lender, has did analysis where it looks at the annual income required to be qualified to purchase a medium home. And in Vancouver, it is about $230,000 of household income in order to be qualified to purchase an average medium home, followed by Toronto, Victoria, etc. And when we look at another interesting analysis, is in terms of the number of months required to accumulate this minimum down payment in the various cities. In Vancouver, it would take an estimated 360 months to accumulate this minimum down payment, assuming a 10% saving on their income. Again, this screams an affordability level in these expensive cities and making it very hard for homeowners to want to start a home. And this ultimately would affect the home resales activity. In 2021, we saw the highest level of Canadian home resales, and based on various banks' consensus, it is expected to go down by 23% in 2022 and a 14% decrease in 2023. So, it's certainly a significant decrease from the historical high we saw last year. On the right-hand side here, we look at the actual monthly data, and you can clearly see the last 3 months, there's a clear sign of cooling down the market where sales activity have finally come down. And this translates to a material price correction in early to mid 2023. Based on bank consensus estimates, it's expected to go down by 7.7%. And this is significant, especially when you're looking at a home of $2 million, for example. That equates to approximately $160,000. And when we look at the actual home price index all the way from 2005, broken down by various cities, we can see that it's starting to trickle down and starting to decrease in pricing, but still at a pretty high level. When we look at 2023, again, these are bank consensus estimates, and banks' forecasts are all quite similar across the board. We see Toronto and Vancouver expected to go down by 8 to 9%, Fredericton down by 7%, and just given that they have massive growth over the last 2 years. Cities like Halifax and Montreal are expected to go down by 5 to 6%. The other cities are expected to go down from 1 to 2%, and that's largely because the purchase price for homes are lower there, as well as they're more resilient to interest rates because of lower purchase price. Overall, after 2 years of buying frenzy, the Canadian housing market is certainly expected to cool down, particularly given Bank of Canada's aggressive path of raising interest rates. In the next 6 to 12 months, we will see a decrease in home resales activity as well as prices. For the next video, let us know if there are any topics you want us to cover, and we'll do a deep dive. As a disclaimer, these are our perspectives backed by analysis and data from Canadian banks. This is not meant to be investment advice or considered professional advice. So in all cases, you should consult with professional advisors. We hope you enjoyed the video.